Hello, everyone. Welcome to this Carta event going over the state of private markets in Q2 2024. My name is Peter. I am the head of insights here at Carta, and I'm really appreciative of you spending some time with us today. Thanks so much. So we have a lot to cover. We have a full data report that covers everything from valuations, fundraising, deal terms, all sorts of stuff from Q2. And then we'll get to the great part, which is I will invite my guest, Samara Hernandez of Chingona Ventures, up on stage with me, and we'll discuss all of your questions. Thank you so much for those of you who submitted questions before this event. We got quite a few of them. I don't know if we're going to be able to touch on everything, but we will do our best. And as we go along, if you find something fascinating or you want to just comment or jump into the conversation, feel free to use the chat or the Q&A. We'll be monitoring those as well. All right, let's get into the data. So as you all know, if you've ever attended one of these before, I am a huge nerd, and I want to start with the numbers. So what happened across private startups in the US in 2024 Q2? First, a bit of text from our lawyers. I'm sure you all already read that. Great job. Second, yes, you can have this deck if you want, but all of the data in this deck is actually in the report itself. I just dropped a link into the chat so you can go read that at your leisure as well. Let's start with fundraising. Okay, so in general, the way that we've titled these events, Slow and Steady Progress, I think is reflective most of all in these fundraising numbers. So if you just follow that line there, that's the total amount of capital that was fundraised by Carta startups, of which there are about 45,000 now, every quarter. So in 2021 Q4, nearly $70 billion was fundraised by companies on Carta. In the most recent quarter, that's 21 billion. So we are nowhere near where we were in the boom times, but we have seen 3 straight quarters of growth in total fundraising. So that is something to get perhaps not fully excited, but a little bit excited about. At least we're no longer falling. And if you take a look across these stages, the black line in this chart is the difference in valuation over time, and the orange line is the difference in total rounds completed. And what this view shows is that it's actually been hardest at the late stage, Series C, Series D, and beyond. Those places, the valuation and the fundraising both turn down simultaneously. Whereas at the early stage, seed and Series A, there's a bit of a gap where the valuations are still pretty robust, but the fundraising pace has definitely slowed. So that can feel kind of confusing for entrepreneurs. It's not as though the valuations have gotten terrible lately, but it's just that the round activity has slowed down, so that it feels very, very sluggish if you're in the trenches right now trying to fundraise, I'm sure. And then perhaps the most useful point for entrepreneurs on this call, the time it takes to raise a round, the gap between the day you raise your seed round and the day you raise your Series A, continues to rise. So this is something that we've seen quarter over quarter. It's gotten a little bit longer between these periods. So if you are trying to fundraise and you expect to go back out to market in 18 months, you may want to prep that it's going to take 20 months or 24 months or even 30 months occasionally, because it is taking longer between these rounds. Just to give you an example of what we mean by taking longer, each one of these lines is a cohort of seed stage companies. So all the seed stage raises that happened in Q2 2020. And about 47% of those companies ended up getting to Series A within 3 years. But if you look at the 2-year mark, companies that raised in 2020, about 40% of them got to Series A within 2 years. Whereas companies that raised in early 2022, only 15% of them have gotten to Series A within the same 2-year period. So these cohorts of real tons and tons of startups that raised in early 2021, late 2022, they have been the ones that have been caught in the middle during this venture downturn. Let's jump over to the types of deals that we see on the platform. So first off, I think this is a wonderful signal. Down rounds are at a 6-quarter low. So the percentage of all rounds that were actually down rounds, meaning the valuation was less than the valuation of the round prior, was at a 6-quarter low. That is wonderful to see. Hopefully that continues back down towards the historical average, which is about 10%. We've also got bridge rounds declining. And that is also good to see in my view. It means that venture capitalists are spending more time investing into new companies and spending a little less time trying to keep their current portfolio companies afloat with bridges and extensions, which can take up a lot of time and effort for VCs. And for those of you on the call that are maybe in between this priced round and safe world, like when do I switch from pre-seed to seed? What does seed even mean these days? We can talk about that more in the discussion, but this is a good outline of what we see for founders. So if you're raising less than $3 million, a safe is probably the right one. If you're raising less than $1 million, a safe is definitely the right path for you. If you're raising more than that, you probably want to think about doing priced rounds. Priced rounds are not scary. They're actually great. Yes, they cost more in terms of legal fees. And yes, they can take a little bit longer. But all of those safes that you've already raised, converting on the cap, that can actually be good for you as a business. So we can talk about that more if you want. And let's get into valuations. We'll rip through this. So the median valuation for a seed stage company on Carta is actually $15 million pre-money in Q2. That is super high. That is wildly high. What I think is happening there is there's a lot of big AI raises that are bumping up that median. If you strip out AI, it's more like 13 or 12.5 million, which is still pretty robust, to be honest. Series A has been flat through all of 2024. $40 million pre-money. You add about 10 million raised in that round, and you get to close to about 50 million in post-money valuation for Series A companies on Carta. Series B valuations, you can follow that black line for the primary there. They've actually perked up quite a bit in 2024 after falling drastically in 2023. So not a lot of Series Bs happening, 185 last quarter versus 400 in a quarter in 2021. But we are seeing those valuations rise back up a little bit, which is cool. Series C, again, a little bit of a rise, but kind of a muddled picture there. And for those of you that are maybe thinking about exits, what is happening in the exit environment? We've heard that IPOs are closed. We did see that the number of startups that got acquired last quarter actually continued to rise off of some recent lows in 2023. So maybe M&A markets are getting a little bit more exciting after being kind of stuck in neutral for the last year or so. Last section for me, and then we'll jump into this conversation. So have your questions ready in the chat if you haven't already. I wanted to spend a little time on teams and places. So team size and the places where this investment is happening. I think this is one of the biggest points that's become clear over the last 2 years. As fundraising has dried up, hiring across startups has also gotten a lot harder. So the black bars on this chart show you how many people were hired net of the people who left from Carta companies in a given month. So that peak in 2022, nearly 54,000 more people joined than left that single month for all the companies on Carta. And you can see in recent quarters and recent months, it's just kind of been flat. Startups are not really growing headcount. In fact, if you look at it at the stage level, they're actually smaller than they used to be by quite a bit, which maybe kind of follows on with all the layoff talk that we've been hearing. But the median amount of full-time employees at a Series A company was 20 in Series A's that were raised in 2020, and it's now 16 for the Series A's that were raised in 2024. So companies are moving fast with a smaller team and getting to these checkpoints with fewer teammates than they used to. This is not surprising. A lot of the investment we see is in California, New York, the major venture markets. And if you break that out a little bit, I think two things become really clear. First and foremost, if you hear people saying that the Bay Area is going to lose its place on top of the venture ecosystem, I'm here to tell you that that's definitely not going to happen anytime soon. The Bay is still by far the biggest venture market for us and across every other data set that we look at. The second thing is that Boston has really done an amazing job moving up from that second pack of contender ecosystems into the top three. So it's Bay Area, New York, and the Boston area for us. And it's very clear that those three have sort of cemented themselves as the top three venture markets in the US. And then there's a ton of great second-tier markets like LA, San Diego, Chicago, Austin, DC, all that are kind of up-and-coming ecosystems. All right. So if you want more of this data from us, you can always get it on the left QR code that's joining our Data Minute newsletter, which is one chart from us every week. And if you are a pre-seed or seed founder and you want to get started on Carta for free, you can scan that QR code on the right. With all that data nonsense gotten out of the way, let's bring up Samara and have a long conversation about what's going on in Q2. I'll go ahead and stop sharing this. All right. And Samara, how are you this morning?
Good. I always love your energy, even if you're saying, you know, something's not great, but you know, I love the energy that you bring. I think it brings on a lot of optimism, and because there is a lot of optimistic things, so it's good to highlight both what's real and then what the opportunity is.
Well, thank you. Yes, maybe my energy is trying to elide some of the scarier parts of the data there, but hopefully it wasn't too misinterpreted. Yeah, so I wondered if you might want to kick us off by just giving us a little bit of sense of what you've seen from this quarter, or maybe throughout this full year, and how that compares to, say, 2023.
Yeah, look, it's in line with what you're saying as well. So we pull a lot of information internally at the fund. And, you know, the way we think about it is last year was the year of correction. Yes, last year was something that needed to happen. There was a ton of capital in the ecosystem. Everything and anything was getting funded, right? People were spending, valuations were crazy. I mean, it's something that just needs to be corrected. The way we think about this year is, if you think about last year as winter, or like a true Chicago winter, call it January, February, where it's like doom and gloom and get me out of here.
Right,
and
frozen.
You think about this, frozen, exactly. Then this year is more Q1, Q2 is more like early spring, right? So it's more of, all right, there's some things coming out. You're starting to come out of your house. They're starting to see some happenings. It's not full summer. It's not like everybody's out. You're starting to see that, right? From a deal flow perspective, in terms of the companies coming in, the number, the quality of startups. I think last year we saw a lot of companies coming that were having a hard time raising. We saw a lot of pre-seed plus, seed plus, you know, bridge rounds coming through. And we didn't know if that was actually companies that were just doing really good and they just needed true, you know, a little bit of capital to get to accelerate, or those that were just not doing well and just needed to raise just to stay afloat. And we saw a lot of those. We're seeing less of that. So it is tying into the data that you're showing. And, you know, even though we saw from a valuations perspective, we saw it go down last year, we actually started to see it flatten, especially in the early stage, if not increase slightly. So you brought up the point around seed. It's still elevated. And even if you strip out AI, to your point, it's still pretty elevated from the seed perspective. And we've seen that as well. On the pre-seed side, we started to see it normalize and go down a little bit, but it's still not at the levels of when we started the fund in 2019. I mean, we were getting in pre-seed from $3 to $5 million pre-money valuation or caps on saves. Now that's closer to 5 to 10. Yeah. So even though we've started to see some normalization, some declining, it's still elevated from both the pre-seed and the seed.